Good morning, everyone. Welcome to this update for global stocks and commodities for the 15th of March. My goodness, what a week. I started my journey in the stock market in 1987. My recollection of Black Monday has faded a lot, but I can't remember anything like the week that we've just seen, not even 2008. I think would compare with the sort of volatility in both directions that we saw. Now, we finished off the week. I said last week that a significant low in the market would occur when the news was absolutely the worst. And after Thursday night in the States, and then even the start of action in the States on Friday night, the markets just looked absolutely terrible. And then there was this stunning reversal that you just have to pay attention to. So what I want to do in this edition, it's not necessary to understand all the whys and wherefores, because price action is king here, and that's really what you should be trading. But I find if you have at least some sort of appreciation of what caused the crash, and then what caused this extraordinary rebound we saw on Friday night, then it helps you to make more clear thinking decisions, in my view. So I think it is worth at least examining those facts. So let's jump into it. So really it's just an examination of, my goodness, what just happened. We had a crash of monumental size, and then an absolutely rip your face off rally on Friday in Australia in the last hour. And then that flowed through to America as well, where the indices were up by 9.5%. And many of the world's largest companies rose between 15 and 20% in a single session. I mean, this is just extraordinary sort of price action. We will look at the stock and commodity trend update. Portfolio analyst last week, it was really about how do you keep your head straight through this kind of market action? And I think that's the most important focus at the moment. So let's take a look at the week in review. First of all, why did it happen? You know, why did the last 3 weeks happen? And in particular, why did the price action completely fall apart last week and created the fastest crash since 1929? Well, I've been speaking for several years about the ETF, the passive ETF spiral upwards, and how it was unclear how that would unfold if it ever went into reverse. Because what this move from active fund managers to passive fund managers has done has meant that there has been this mindless upward momentum that feeds on itself in the ETF market, where there's no value assessment occurring. And I've been talking about this for years. Well, we found out last week, because that mindless upward spiral turned into a forced redemption spiral on the downside. And I think that's one of the important things that everyone needs to understand about last week, that the vast majority of what happened in the selling was not a result of people looking at the market and making a considered value judgment. So much of this was forced selling for other reasons, and that's really what I want to focus on. Now, I'm not sure which one came first, whether the ETF downward spiral started or the margin calls started, probably in this order that I'm presenting them. But once that forced redemption spiral started, then that means that the passive fund managers that run the ETFs then have to sell real stock to fund those redemptions. And so then that started triggering margin calls. And the margin calls came in all parts of the market, not just stocks. There would have been margin calls in currencies, in the bond market, you know, in all sorts of places, commodity markets. And a lot of those instruments are relatively illiquid compared to the volumes and the leverage that was being traded. But if you look at the gold futures market, just for one, the speculators in the gold futures market work on a leverage, an average leverage ratio of about 25-1, which means that the underlying asset only needs to move 4%. And if they don't take action, they get wiped out. So there's some extreme leverage out there, and there's a lot of illiquid instruments. And so therefore, when you're getting margin calls on illiquid instruments that you just cannot get rid of to either reduce your exposure or to raise cash, then you just have to sell whatever isn't bolted down. And that is why we saw the gold price get hammered. And the same thing happened in 2008. And I talked about this on the video, the special video that I did on Friday, the fact that gold stocks in the early part of the GFC performed as badly as anything else, didn't provide any protection. But once we got to the worst of the GFC, which was October, then gold stocks bottomed and turned up dramatically and went up nearly 300%. So the margin call thing certainly has a rolling impact throughout all asset classes. And as I said, the illiquid ETFs are a real issue. And I've had a couple of questions lately from people who they want to target a certain part of the market. And so they go and find an ETF that does that achieves that exposure to that part of the market. But a lot of those ETFs are quite illiquid. And in this sort of market, illiquid ETFs are not where you want to be. They're absolutely not where you want to be. They're incredibly dangerous, even though some of them maybe, appear to be all-encompassing. And the Australian ETF market is not as well developed as the US market. And so some of them that provide exposure to the whole global stock market, and therefore you might think they're safe. They're actually not safe because they're not very liquid. So just be careful. Now, of course, the triggers came from, and again, I can't ever remember this, we got two black swan events back to back or simultaneously. The virus and then the oil shock. And that just created this extraordinary fear of the unknown, but I guess everybody knows that now. There was disruption to credit and debt markets, and that's why governments have stepped up with just extraordinary stimulus. We then, of course, had technical levels being broken almost by the hour. That set the algorithms just absolutely berserk. And in fact, most of the computer algorithms have certain de-risking strategies embedded in them. And the market moves were so extreme that those de-risking strategies actually failed. They weren't able to do what they are designed to do. And so the algorithmic programs just went into an absolute meltdown. And then I think finally, the Trump travel ban on Europe really put the icing on the cake, and the cancellation of sporting events around the world, and effectively the lockdown of economies and people's ability to move around, I think put the absolute fear into everybody, because now it was really close to home. Now we couldn't watch our favourite sport on TV. We couldn't go to our favourite sporting event. And so now it was personal. And that just added to the panic. So, look, if there was ever a perfect storm, this was it. Okay, so then roll on to Friday. Why the reversal? Now, it doesn't really matter why. You don't need to understand why. You just need to sit back and observe that it was the most extraordinary reversal, accompanied by massive, massive money, and therefore this is a meaningful reversal. So why did that happen? Well, the US effectively put in a $5 trillion commitment of stimulus. And I saw it very humorously referred to through the week as the US Fed bought an aircraft carrier to a knife fight. That was the size of it. We saw the Bank of Japan increase stimulus. China increased stimulus. The ECB increased stimulus. So everyone, the RBA, so everybody is on board with this. We've got this incredible stimulus around the world. There are certainly signs, and I don't want to comment. I don't want to use this forum to comment on the virus, because clearly it's a very emotive issue, and I've been attacked by people that have got a different point of view to me, and that's fine. They're entitled to their view, but please, everyone, let's just be respectful. but it serves no real purpose because I want to keep the focus on the stock market. The facts that I'm looking at, and I'm trying to deal just with presenting facts here, not projections or opinions, but the facts seem to support that China's getting better. There were 10 new cases of the virus on Thursday and 3 new cases on Friday. Now, some people will jump up and down and say, oh, yeah, but they're lying. Those facts aren't true. But there is other supporting evidence with regard to electricity consumption, with regard to the number of cars on the road in China. There is certainly other supporting evidence that would suggest that China has got on top of this fairly quickly. But again, all I'm doing, please don't fire off broadsides at me on this because this is a stock market forum, not a forum for for a debate on the virus. But it would appear that China is getting better. There was short covering, of course. All the people that had made some unbelievable profits out of the dive in the market eventually have to cover by buying back, and so therefore we go from a situation where everyone's a seller to all of a sudden the sellers disappear and almost everyone's a buyer. And the fundamentals had reached the PE index, the PE ratio had reached on the index had reached the lowest level in 6 years, and so that made the smart money sit up and take notice. That started the reversal, and then the short covering had to kick in as well. So that's what's happened. An overall perspective. Cash up early, which I did make very clear to members on the very first Monday that this all broke apart. Cash up early or not at all, because as you go through this incredible cascade to the downside, you never know where the bottom is, and it's incredibly difficult to get out and get back in again. So last week I said that markets look forward. The best opportunities will come when the news is at its worst. It was extraordinarily bad on Thursday and Friday, and we immediately got an unbelievable reversal. So trying to get in and out on better terms is nearly impossible. When stocks move 20% in a session, it can't be done. So you got to wait it out. Now, the VIX hit 78 on Friday, which is only just shy of the absolute peak in the GFC when the world's financial system appeared as though it could completely fail. And it still finished at 57, which is still above almost every other event, with the exception of a brief period in the GFC. So the response in the fear index is absolutely historic. But we now have a rally that can be traded. And if you're not prepared to trade this rally, then you probably should get out of the stock market forever, quite frankly. Now, I'm not saying how far it will go, but I'm just looking at the facts. I'm just looking at the weight of money and the price move. And, involvement in the stock market is about probability. It's not about absolutes or guarantees. And this was such a powerful reversal that the overwhelming odds are that it's going to be tradable for a period. Now, whether that's weeks or months, I have no idea, and neither does anybody else. But it's certainly one that can be made use of to help repair some of the damage. Overall, stay calm and focus on the facts. I'm still getting stuff from people that are projections and they're guesstimates, and they're a whole bunch of fear. And it's really hard to escape that rhetoric. But the projections that are being made, frankly, are useless. And if you buy into them and you then present them to others as this will happen, then, that's not helpful. No one knows how this is going to unfold. So let's just stick with the facts, because it gets in your head and it clouds your judgment and it prevents you from making clear-headed decisions. So just try and stay away from the fear projections if you can. Be conservative with what you do in the market and what you do in life in terms of social distancing, etc. But seek opportunity. Be positive. There's only one way to live your life, and that's with a positive attitude, because there's always opportunities. And right now, the projections that some people are making do not allow for the fact of what very ingenious mankind might come up with. It's only looking at what we know now, but what about what might be coming next week or next month or in 3 months? what about a vaccine? It's just those projections are not taking account of what might change on the positive side. Let's look at American stocks. The S&P ended up falling by 261 points for the week, which is just under 9%, but it was down double that on Thursday night. This could be the bottom, the ultimate bottom, but maybe it won't. I'm not making any statement about that at all. All I'm saying is that what occurred on Friday night was such an emphatic reversal that the overwhelming odds would support it following through for a period of time and for a decent distance, which is now tradable. You can make money from this. This is where an understanding of how the real world dynamics impact prices. And let me give you an example of that. With the turnaround in Australia on Friday and then the massive move in the States on Friday night, it is almost certain that we are going to get a big gap up on Monday morning. Now, you don't want to buy into a massive gap up because you need to get an edge. So if you buy into, let's say, a stock that rises, gaps open by 10% on Monday morning, then that's 10% that you might need to make a tradable position out of that. So there's only a certain premium on Monday morning that is worth taking. Otherwise, the trade is not worth taking. So if you can't get it, if the gap up is so large that you can't get into the trade, then don't do it. So this is not a market open to be chased at any cost. So you need to understand the dynamics, because there is also, and I've seen this so many times, there is also a good chance that a huge gap up opening, then stocks trade down. So, the dynamics should be that you put an order in the market, perhaps at a modest premium. This is just a suggestion. It's not a recommendation, but it's just a suggestion from decades in the market of observing how these things play out. Put a price in the market that you're happy with, might be at a modest premium to where it closed on Friday, and then just see what happens and play it from there. So it's really important to understand how the real world dynamics impact here. Consider how the herd's going to act, and absolutely do not do that. Now, the US dollar rebounded massively. It had been on the slide, got down to 94, I think, but it rebounded to 97.5. The 10-year yield actually, in fact, that shouldn't be 0.5. The 10-year yield actually hit 0.4% at one stage, but it did rebound almost to 1%, but it's still, historically low. All right, let's jump in and look at a chart or two. This is the S&P. The technical damage here is incredible. We had, if we look at the analysis, the Fibonacci analysis of this, so we had a very sharp run down. We bounced 50%, which is about par, and then it all fell apart again when the oil shock hit as well. Now, here's the low in 2018. This could be the ultimate low, or we may get a bounce of some dimension and then we come back down again and retest that lows. We will get some sort of retest. I don't know from what level, or whether it will form a higher low or an equal low or a lower low at this point in time. But the price action and how this plays out in this sort of situation will give us a guide. Now, if the S&P can only rebound to around this level, then that's a fairly weak bounce. And I would suggest that we're probably going down again fairly quickly and probably to a new low. If it can make the 50%, that would be more encouraging. If it can make its way back above 3,000 in this rally, then that would be a sign of strength, and therefore that would drastically improve the odds that any retest, of which there almost certainly will be, is probably going to form a higher low. So let's just see how it unfolds. But you can see just the scale of the rebound on Friday. So we opened, we gapped higher because the US futures had followed Asia, followed Australia, followed Europe, so that the futures were actually were suspended before the US market opened. They were trading limit up, and we then got some selling, as you can see. So it gapped up, but then it sold off again, almost down to where it was on Thursday night. But then the rally kicked in, and it kicked in with extraordinary volumes. Now, let's just look at, so let me just show you a couple of specific stock examples. And again, these are purely examples. These are not recommendations. I just want to look at two of the world's biggest stocks, because you shouldn't see moves like these in stocks of this size. And this just underscores just how momentous Friday and last week was. This is American Express, so everybody knows American Express. Huge company. It rose by 19.5% on Friday night. It's almost laughable that stocks would move around in this sort of fashion. You know, look at the price action, look at the volume, and that's all you need to know. That's the facts right there. Let's look at JP Morgan, the world's largest bank. Up, I think it was 18%. So the biggest bank in the world rose 18% in a single session, with a lot of that happening in the final hour. So quite extraordinary moves. And certainly I've already been recommending to members, you know, what particular stocks and how to take advantage of this. All right, let's look at the US dollar. So this is on a weekly chart. So you can see we certainly did we fell out of the channel, the upward channel. We fell out of the sideways channel, and it was clearly in free fall. And then we got this massive reversal. And if we put this on a daily chart, you can see just the scope of the money flowing back into the US dollar on certainly on Friday, but really throughout the week. And that's pretty normal. In an absolute panic, money flows into the US dollar. All right, let's have a look at Australia. Oh, let me look at the Australian dollar first of all while I'm here. So the Australian dollar now is completely broken down, finished at 61.9. And as I pointed out last week, we've got support here at 60. So we're not far off that. And then also support at just under 50. So for anyone that had money in the States, in the stock market, it was a pretty good week actually, because the currency fall, as long as you weren't heavily exposed, the currency fall was so significant that that would have given you a really good boost. Let's look at the ASX 200. So just look at the turnaround on Friday. Quite extraordinary. Now, there's no question there's been a massive amount of technical damage done. We broke through key levels, and as I've done, for those that have been following these videos for any period of time, in 2016 early, what I look for is where we get a break of the swing low, and that then indicates that you should be taking some action. And we've certainly had a very significant break of an important low. So I'm not underscoring the importance of this technical damage. All I'm talking about here is the fact that this is such an emphatic rebound. It proves that there's big money. Major fund managers have committed themselves to this market, and they don't do that for just a couple of days. That's not how they work. They saw such extreme value in stocks like BHP and Rio and Commonwealth Bank and a whole raft of other stocks that they committed money to the market. So that is likely to see some sort of significant follow through. All right, let's continue on. So the Aussie stocks, 61.9 is where we finished. It was a combination of, US dollar strength and just the whole fear environment that's taken hold. We fell 677 points on the week, or 11%, but it was down 1,100 points at the low late morning on Friday. So we then saw a 666 point reversal on Friday, 14%, and it was on a record turnover of about $20 billion. Now, a normal day, normal average day is around about $5 to $6 billion. A peak day, a really big day, is about $12 billion. So $20 billion of turnover went through the Australian stock market on Friday. So this was not just a price reversal, this was a huge commitment from big money to the market. So now what happens after a crash like this is that the small caps don't get the love first. The money goes into the large caps first. That's where the liquidity is. And so selected large caps, not all large caps, and you absolutely want to stay away from anything with any debt. Selected large caps, or any appreciable debt, I should say. Selected large caps are going to rebound the fastest. So if you're looking for very short-term impact, that's where you need to focus your attention. Large resource stocks with low debt should be one of the winners. Now, again, nothing is guaranteed in life, but they should be one of the winners, particularly as China gets back to work. All right, let's move on. And of course, as I said earlier, I'm just all over this with special updates, special intraday alerts for members of my services. Now, looking at precious metals, gold plunged $145 across the week, down to $1,530, and I explained that earlier. Would appear to inexperienced people that's a real head scratcher. Why wasn't gold strong? And it was just because of liquidity. And of course, the futures overhang that I've been talking about for some time, that finally kicked in, and there was also a bit of a reduced fear as well around China in particular. So people saw a little less need for gold. I know there's a massive amount of media panic out there, but a lot of the cool heads are, looking at opportunities. But the futures overhang has finally kicked in to a degree, and that's a good thing. The other point I'd make is that the market is, as far as gold is concerned, is not making any allowance yet for the mountain of debt that not only have we got, which is more than double what it was in the GFC, but is now set to escalate, dramatically, with the US committing $5 trillion. So the debt mountain is going to get bigger and get bigger very rapidly. And that long term has got to be good for gold. Now, if we look at precious metal stocks, GDX got absolutely murdered, particularly on Friday night, and it was down 35% for the week. Now, gold was down about 8 and a bit, so normally GDX would move about 2 to 3 times the move in gold. It moved 4 times the move in gold, or just over 4 times. So, that's a complete capitulation in gold stocks. So again, we may not be far off an incredible opportunity in the gold market. And the reason that I say that is that if we look back at the fundamentals, the quarterly results that are just starting to filter through now are for the world's biggest stocks. The profits are soaring because the gold price was up. Costs have moved up a bit, but the gold price has gone up a lot faster. So profits are soaring. They were up quarter on quarter. They were up something like 59% in the first quarter. In the December quarter compared to the quarter before, and therefore as a result, the PE ratios are plummeting. So we're almost to one of the best buying opportunities in the last 10 years for gold and gold stocks. Now, we're not there yet. You don't want to try catching a falling knife, as we'll see. But this is now getting to really compelling territory for buying gold stocks for the medium to longer term. There's the gold price. Really fell apart, as you can see, on Thursday and Friday as the need for liquidity really reached its peak. Let's look at this on a weekly. You can see just how dramatic a week it was, and it actually dropped out of the trend channel. So then if we go to GDX, you can see Wednesday was bad enough. Sorry, this is a weekly. Beg your pardon. So 3 weeks ago was bad enough, but look at last week. Really quite extraordinary. And let's zero in on the daily, and you can see just how much selling, but it certainly did bounce off the lows on Friday night. So we're not there yet. Wait for the price action. Wait for the market to show you. Play the ball as it comes at you. But this is certainly now into a zone of tremendous opportunity. Other commodities, copper didn't move a lot, only down a little bit. But crude oil got absolutely murdered, and at one stage was trading at about 29. So it came down a lot, came down about $8 or $9, down to 32.3, and the sector, oil producers, oil service companies, the whole sector just got demolished. And of course, a lot of this is around the indebtedness, particularly of a lot of the US shale oil companies. So it's almost certain that we're going to see a significant rise in defaults. And the worry then becomes, of course, what impact does that have on the corporate bond market? And if it was large enough, then it can actually flow through to other sectors, non-energy. But if you look at, and this is a fact, if you look at 2016, when oil hit $26, it didn't crash the corporate bond market then, and therefore it's probably not going to do it again. So I wouldn't, I wouldn't get fearful about this. It's something that is worrying a lot of people, and it's certainly something that I'm watching very closely. But it didn't crack the bond market in 2016, and let's hope it doesn't have that impact this time around. There's the spot copper chart, down a little bit. Nickel, pretty steady. So my final thoughts. This was a capitulation low and a reversal of great substance. It may not prove to be the ultimate low, but it's certainly a rally to buy, that's for sure. I wouldn't commit all your capital because a retest in following weeks or months remains a possibility, and probably a distinct possibility. And those odds can't be determined at this point in time. So therefore, you've just got to work a bit conservatively here. Avoid speculating what might happen. And just trade the opportunities as they present. It's just the only way to go. A portfolio analyst coming up is really just putting the list to work as the opportunities present themselves. So a momentous week last week. Who knows, what will happen in the weeks coming? But certainly we're going to have a very, very bright start to trading tomorrow, unless something comes up over the weekend that is unexpected. But again, let me just repeat: the market bottoms when things look their worst. And I've just been watching the global news this morning, and the news about lockdown in Spain, lockdown in France, and effectively a border closure by New Zealand. I mean, the headlines are rolling through almost by the hour. The news is terrible. It's absolutely terrible, but you've just got to try and look forward, look for opportunities. So I'll leave you with that thought. There's my contact details. This is a time, unless you've already got a great deal of experience yourself, you've been in the market for more than a decade, you certainly would have needed to have gone through the GFC experience. If you don't have that sort of experience, my goodness, you need to be leaning on someone else's perspective at a time like this. So if anyone hasn't availed themselves of the portfolio analyst trial, I'm trying to provide that perspective to members as much as possible. I think it's a step worth taking. So that's it for this week. Cheers.